like you said at the beginning, everything we're saying today is, I guess, assuming that an investor has the ability to be well diversified.
Yeah.
Like, for example, in our equity model internally, I mean, there are a few companies that have a very high price per share. All right. I can think of a few off the top of my head, like a BlackRock and Equinix and Costco, O'Reilly. If you have let's just say $5,000 of investable assets and, you go and buy O'Reilly, which trades over $1,000 a share, that's just not something that we would view as prudent because you don't want one name taking up 25% of your allocation.
Yeah,
right?
not well diversified.
No. And so this is all operating under the assumption that you can be well diversified, whatever that portfolio size actually looks like. The other thing I did want to say related to what you were talking about with regards to, there are times when it hypothetically can make sense to just buy a neat bundled package. The one thing that is very important to consider is that because mutual funds and ETFs sometimes offer a little bit less transparency in terms of what's actually being held, if you're not working with a professional, there can be some serious concentration that happens there.
Yeah.
Let's say, you have an S&P 500 index mutual fund, and then, for some extra juice, someone puts in there a technology focused mutual fund. All of a sudden, you could very easily have half of your investment allocation on the equity side allocated to the technology space. Because of that concentration that's developed in equity markets, I think it's a lot easier to fall victim to that concentration risk if you're just allocating to passive ETFs or even active mutual funds. And that's just something that I think is really, really important to consider. Should be spotted by any financial advisor or financial professional, but because the experience has been so good over the last 10 to 15 years, either people ignore it or they haven't identified it.
Yeah, no, and that's a huge risk right now. I mean, so this was through the end of October, the year-to-date return in the S&P 500 was, 46% of the year-to-date return in the S&P 500 was 5 names: NVIDIA, Apple, Meta, Microsoft, Amazon. So if you're a fund manager, you're managing a mutual fund, your goal, how you get bonused out, your incentive structure purely revolves around you outperforming the market. What are you going to do? You're going to be over-concentrated more so than the market is in those 5 names. So Absolutely. And that's a great story when the tide is rising, but when the tide pulls back, we've seen this countless times and time again. When you don't diversify well, what can happen to a portfolio in a quick amount of time?
Yeah.
Easy come, easy go to some regard with some of those quick returns.
Yeah.